screen. If you did not receive a copy, the slides are posted on our website, which is www.economicprogressri.org/RI Health Coverage Project. We will also email the slides and a recording of this webinar later this week or early next week. You should all be on mute, but we welcome questions. You can type the questions into the box on the right-hand side. We are going to take breaks to answer questions at several points during the presentations. So we will go through, write those questions down, give them to our panel, and then Carson will answer the questions at those specific time periods. If you're not able to type the questions for some reason, you can email me at rflum@economicprogressri.org. Again, that's rflum@economicprogressri.org. Those should be on your screen now. And if we don't get to your question today, if it's not on topic or if we don't have the answer, we will certainly respond with a follow-up email later this week. And with that, I will turn the presentation over to Carson.
Great, thanks, Rachel. Good morning, everyone. I hope everybody's as excited as I am to review the upcoming tax season information. For some of you, I would imagine you attended our webinar last year to talk about the 1095s. And for some of you, this is probably new. So there is going to be some new information for you this year because we have 2 additional types of 1095s. So we're going to talk about that. Give me 1 second. Okay. So today we're really going to focus on 5 key topics. The first one we're going to talk about is looking at everyone who's eligible must have had health insurance in 2015. I think everybody knows by now that everybody is required to have some kind of health insurance, including whether it's through HSRI, whether they go directly to their employer or go direct to carriers or Medicaid. So simply for most people, it's really going to be just they're going to need to check the box on their tax return indicating that they did have coverage for the entire year, and they will not have to do much more than that. There are, as I mentioned, going to be 3 different types of 1095s going out this year. Last year there was 1, that was the 1095A. That is going out again this year, and that would be going to people who are individuals or families who purchase their coverage through HSRI or another exchange or marketplace. This year there's the addition of the 1095B, which would be issued to people who either had Medicaid or Medicare or through their job if they work for a small employer. This would include SHOP if you are covered by HSRI through our SHOP program. And then individuals or family who purchase their coverage directly from a carrier. And then the third form is the 1095C, which would be given to people who work for a large employer, which is generally speaking, it's going to be more than 50 employees. Sorry. The third thing we're going to be talking about today is what happens for the people who did not have coverage in 2015. As with last year, in 2014, there are penalties. The penalties did increase for 2015, so we're going to take a look at that. The other thing to consider is whether or not somebody had an exemption, so we'll talk about what those exemptions are and some of the qualifying reasons. And when I say exemptions, that means, in other words, an acceptable reason to not have insurance for some portion or all of the year. And finally, number 5 is we're going to talk about the APTCs. We're just going to review that. It really is not much different from last year. Oh, I just got a quick question about what is SHOP coverage. Sorry. That's for small businesses who purchase insurance through HSRI. So we have both the individual and family market, where individuals can go directly and buy from HSRI, purchase their coverage through HSRI, or the small business market can also go through HSRI and purchase coverage for their employees there. Okay, so moving on. Sorry, my computer's a little bit slow today. There we go. So as I mentioned before, everybody has to have health insurance at this point. Some people may refer to it as the individual shared responsibility, also referred to as the individual mandate, and it applies to everybody, children and adults. And as I mentioned before, a vast majority of people who are filing their taxes, it's really going to be an easy process for them. They're simply going to just say that they had minimum essential coverage for every month of 2015 by checking the box on their tax return. They will not need to include the 1095A form, A, B, or C form, and no further action is required. There will be some action required with the 1095A form, and we're going to get into that a little bit later on. So let's move on to talk a little bit about what examples are of minimum essential coverage. Almost all coverage will be considered a minimum essential coverage, but it is important that people understand whether or not the coverage they have is minimum essential coverage, because if they have some kind of coverage that doesn't meet those standards, then they will not be considered covered for the year and will have to pay the penalty. So most government-sponsored programs are considered MEC, or minimum essential coverage, including things like Medicaid, CHIP, Medicare Part A, Medicare Advantage, and most TRICARE programs. Additionally, employer-sponsored group coverage is generally going to be MEC, and that can include COBRA and retiree coverage. If you have any questions about that, you should ask your employer, and they should be able to answer that question. And then the individual market with the qualified health plan, so purchase through HSRI or purchase directly from carriers, or if you're in a different state, purchase from that state's exchange. So generally speaking, the 1095, whether it's the A, B, or the C, will show that you had MEC, or minimum essential coverage, for 2015. And as I mentioned before, last year it was only people who purchased commercial coverage through HSRI who needed the 1095A. This year, as I mentioned, there's the A, B, and the C, and it depends on the type of coverage you have that will dictate which type of 1095 you'll receive. So just because someone receives the 1095, it doesn't mean that they need to file a tax return. If you receive a 1095B or a C and you do not meet the filing thresholds, you are not required to file a tax return. But if you did receive tax credits through HSRI because you purchased coverage through HSRI, even if you don't meet the tax filing threshold, you are required to file a tax return. Some people may receive more than one form. So for example, if parents purchased commercial coverage through HSRI and children are in right care, they're going to receive two forms. The parents would be receiving the 1095A if they received, and the children will be receiving the 1095B. Another example would be a parent purchased through an employer, and if their child or children are on right care. So there are a lot of different times where we could see instances that somebody receives two 1095s. It is important for people to kind of be thinking about the types of coverage they have so that they know what type of 1095 they should be receiving. So these are just some things to know. At this point, everybody who would be receiving a 1095A received what we call the watch the mail letter, which basically just tells people, here's some information about what you're going to be receiving and know that you should be receiving it from us. Kind of a little bit of a teaser to say, don't file your taxes until you've received this form from us if you had tax credits. They began being generated just a few days ago and will go for the next week or so. And so everybody should receive one by a little after February 1st. And that 1095A, it will show the months of coverage, the premium for that coverage, and then the premium tax credits received for that coverage. For the 1095A, that is not the form that you would just simply attach to your tax return. You would need to use Form 8962. So you take details and information from 1095A to put into the 8962, and then that's the form that would be filed with the tax return. And we'll talk a little bit more about that later in the presentation. So the 1095B, as I mentioned, is one of the main things people will be receiving the 1095B for is Medicaid. It's also Medicare and a few other items that we'll talk about in a minute. But the 1095B that's coming from Medicaid from the state is being mailed in batches. It began January 8th, so by now some people have probably received them. And then it will be generated through mid-February. There is a cover letter that we're going to look at in a minute that's included with that 1095B to just let people know what they're looking at. Then there's the actual 1095B and an FAQ. All of those should come together in that one package. If people have other coverage and Medicaid is actually just a wrap, they will not receive a 1095B. They should, from HSRI or from Medicaid, they should be receiving their 1095B from either RightShare, their employer coverage, or maybe a 1095C if it's a larger employer, or from Medicare if that's their main health insurance. Essentially what they want to make sure is the 1095B is the form that proves that they had minimum essential coverage. So as long as if they're enrolled in Medicare and Medicaid is their wrap, as long as they receive their 1095B from Medicare, they are all set for being able to prove that they had coverage. So what do you do when you receive your 1095? The first thing to do is check for the accuracy, especially what months of coverage are shown, and make sure that you are in agreement with what's shown on the form. If the information is correct, there's simply nothing more to do with the 1095B. It's truly just a check to make sure that you and that 1095B are in agreement about your months of coverage. You should keep it for your records just as you would with any of your tax information, but you do not need to file a tax return if you wouldn't otherwise have to do so. If you do file a tax return, all you need to do is check the box indicating that you had coverage for 12 months. However, if in the event that there's an error on the 1095, there is a telephone number here to call. It is a different number from the call center for HSRI, so just keep that in mind. I believe all of you received copies of the slides here, and if you didn't, I know Rachel mentioned that there's a link that you could obtain them. But that number is listed here on the slide. So if there is an error, we will, and the customer should call call this number and explain what the issue is, whether it's probably that the months of coverage are incorrect, whether there are more reflected or less than you believe there should be. And they will work to get a corrected form out to the customer. Additionally, the IRS will be notified about the correction so that when that person files their taxes, they're both seeing the same information. This form will be corrected by either DHS or Medicaid in conjunction with one another. Here's a really important note, however. In the event that there is a correction that needs to be made, it is not necessary for the tax filer to wait for that corrected form before they can file their taxes. Essentially, all they're trying to do is prove that they had coverage for the months, for 12 months of the year. And so if they know that they did and maybe had another way to prove it, say through showing their statements for having paid their monthly bill, or have their insurance cards that show the months that they were covered, they do not need to wait to file their taxes to get the updated 1095 form. So here's that cover letter I mentioned that would be coming with the 1095B. And it basically just gives a little bit of an overview of what we're looking at and a lot of the information that I just covered. It should be included with the 1095B and the FAQs for everybody who receives the 1095B. And just a footnote here that the information comes from Medicaid database, even though it's signed by the HSRI team. We're one big happy family, but the information is coming from the Medicaid database, and the DHS and Medicaid staff will be the people who will be working on any corrections that might need to be made. And here is not the prettiest version of the 1095B, but we just wanted to give a quick snapshot of what that looks like. And you can see where the red circle is. What we're pointing out there is that in Part 3, which talks about the issuer or the other coverage provider, the state of Rhode Island is listed here. So for people who are enrolled in Medicaid, your coverage provider will be the state of Rhode Island. And then down below you can see that the months of coverage are listed here. So for these two people, you've got the names of the covered individuals, their SSN, which is mostly blocked out except for the last 4, their date of birth, and then all of the months here. And anywhere there is an X, you can see those are the months in which those family members were covered. So as I said probably 3, maybe 4 times already, you're simply going to check the box on Form 1040 to indicate that you did have a full year of coverage. You can see it there circled in red. It's really that simple. For people who did not receive any tax credits, they can go ahead and check that box. So before we move on, I think we're going to take a quick second to stop for some questions.
Yes. So far we only have one question, which is asking about CHAMP VA coverage.
Okay, so the question was whether or not the CHAMP coverage is MEC, which is the minimum essential coverage, and the answer to that is yes, it is considered minimum essential coverage. So you can just go ahead and check that box to indicate that you had a full year of coverage. Okay, I don't know that we have any other questions at the moment. So, okay, we're going to move on. And if you think of something that you want to ask back about that, at the end we will stop and do additional questions as well, and we'll stop throughout the presentation. So don't be shy about writing them down and then asking them a little bit later. As I mentioned before, there are penalties if you didn't have coverage in 2015 unless you qualify for an exemption. And last year the amount was a little bit lower, but this year the penalty is the greater of either 2% of the household income above the tax return threshold for a taxpayer's filing status, or a flat dollar amount of $325 per adult and $162.50 per child, which is considered under the age of 18. There is a family limit of $975. Keep in mind, it is the greater amount of either of those two items. So it is certainly not a low penalty this year, and it will increase somewhat for next year as well. It is computed on a monthly basis, however. So if, say, you didn't sign up for coverage until September, but you had coverage for the other months of the year, actually let's use June because my math is not great, so I can easily half the year that way. So if you signed up and had coverage from June through December, then you would only pay 6 months worth of the penalty. So you'd figure out the total penalty amount and then divide that by 12, and then you'd pay that multiplied by 6. With the penalty, it is capped at the national average premium for a bronze level QHP, and we're going to look at that in a minute. If you were covered for at least 1 day in a month, that's considered to be coverage for a full month of coverage. So any portion of a month in which you're covered is considered a full month of coverage. You wouldn't have to use that month as one of the months that you didn't have coverage. And short coverage gaps are allowed under exemptions. Last year, it was something that they would allow you to just indicate on your tax return. This year, there is a little bit more work that needs to be done. But for example, if you had coverage from 1/1 of 2015 to 10/31 of 2015, but not for November and December, you can use Form 8965, not to be confused with the 8962, to apply for the short-term coverage gap. So those 2 months of coverage, you wouldn't need to pay a penalty, but you would need to file for that exemption. So as I mentioned before, that payment, the penalty will increase for 2016. So this is a really critical time. We have just a few days left in the month. So it is so important to get a push for people to come into HealthSource.RI and sign up for their coverage between now and the end of the month, knowing that if they don't have coverage in 2016, they could face these penalties. So for 2016, it's going to be the greater of 2.5% of the household income, again above that tax return threshold for the taxpayer's filing status, or a flat dollar amount of $695 per adult and $347.50 per child. So there is a maximum family maximum of $2,085, but that's starting to creep into the realm of how much it would cost to have the coverage for the year potentially, and that it just doesn't make sense for people to go without that insurance, especially if they decided to go without it, had to pay the penalty, and God forbid something happened and they needed emergency medical services, and now they have all these bills they can't pay. So as I mentioned before, open enrollment does end on the 31st of January. So we just have a few days left. Obviously, if somebody has some kind of qualifying event for an SEP or a special enrollment period, then they can certainly come in at any point during the year to apply for that. But our hope and our goal is to get as many people covered through open enrollment as possible. And it's just as a reminder, if current enrollees are thinking about canceling coverage, just remind them of the 2016 penalties, because it's quite a bit more than it was in 2015. And then every year following 2016, those penalty amounts are going to be based on the 2016 amounts and adjusted for inflation. So let's look a little bit at the exemptions. there are a number of types of exemptions, so we're going to look at what they are and how would somebody apply for the different exemption types. So if insurance is unaffordable for somebody, which means that the lowest price coverage available to that person would cost more than 8.05% of their household income, they would qualify for an exemption. Last year it was 8%. It's gone up just a bit to 8.05%. Another exemption type is if you don't have to file a tax return because your income is too low, that is considered an exemption. If you're uninsured for less than 3 months of the year, you qualify for a hardship exemption. Also, if you're a member of a Narragansett tribe or other federally recognized tribe or eligible for services through an Indian health services provider, then you could qualify for an exemption. If you're a member of a recognized healthcare sharing ministry, or if you're a member of a recognized religious sect with religious objections to insurance, including Social Security and Medicare, those are also both qualifying events. If you're incarcerated, either detained or jailed and not being held pending disposition of charges, and also if you're not lawfully present in the U.S. Coverage is considered unaffordable. So that first exemption we looked at on the previous slide, it means it would cost more than 8.05% of your income in 2015 to purchase coverage either through your employer or a bronze plan through HSRI. So let's look at an example to get a better understanding of what that means. If your household income in 2015 was $15,000 and the cost of your employer-sponsored coverage was $1,500, the lowest cost bronze plan available to you through HSRI is $1,300. Because both of those exceed the 8.05% of your household income, which would have been $1,277.50, then you're eligible for that exemption. So they could certainly apply for that. Again, keep in mind, if you're applying for an exemption, it still means that you don't have health insurance, which is not ideal. But it is an option for some people. So what's the process? So if you're applying for an exemption because coverage was unaffordable in 2015, you must apply through your tax return. You can only apply for this exemption through HSRI if you had done so by the last date that coverage was available in 2015. So if you have not already applied for that exemption in 2015, then through HSRI, then you would need to do it through the tax return. You can apply for an exemption through HSRI if you think that the 2016 coverage is unaffordable. That's because exchanges do use that projected income versus the annual income. So you would need to apply for that exemption. You could apply for that exemption through HSRI now if you wanted to. So if your income is below that tax filing threshold, you do not need to do anything to get the exemption. You may still want to file a tax return anyway because you have the benefit of the earned income tax credit. But keep in mind that if you did receive any tax credits through HSRI, you must file a tax return regardless of whether you are below the filing thresholds. And here's just a little chart about what the different thresholds are depending on the circumstance, whether they're single, married, head of household, etc. So you may be eligible for a hardship exemption for months that you didn't have health coverage if you meet one of the following criteria. So if you were homeless, evicted in the past 6 months, or facing eviction or foreclosure. Additionally, if you received a shut-off notice from a utility company, or maybe experienced domestic violence. Additionally, if you experienced the death of a close family member, then these are all considered hardship exemptions. A disaster causing substantial damage to your property, that could be another exemption. If you filed for bankruptcy in the last 6 months, or if you had substantial debt related to medical expenses in the last 24 months, and then if you had AmeriCorps coverage, all of these could be considered hardship exemptions. Additionally, if you experience unexpected increases in necessary expenses because of caring for somebody who is ill or disabled or an aging family member, that's considered a hardship exemption. If you're claiming any child as a tax dependent, this one's a little bit weedy, but if you're claiming a child as a tax dependent who's been denied coverage through Medicaid and Right Care, and another person is required by court order to give medical support to the child, that does qualify for a hardship exemption for you. Also, as a result of an appeals decision, you are eligible for enrollment in a qualified health plan for the marketplace. Lower costs on your monthly premiums or cost-sharing reductions for a time period when you weren't enrolled in a QHP through the marketplace. We could consider that a hardship exemption as well. If you didn't have coverage because you lived in a state that did not expand Medicaid, that's certainly a hardship exemption. If your individual insurance plan was canceled and you believe other marketplace plans were unaffordable, that qualifies. Also, if you experience another type of hardship in obtaining health insurance, then you would want to, you could certainly apply for that hardship exemption. Some things to note about the hardship exemptions: they apply in the month of the actual hardship, the month before, and then the month after. So it's not necessarily for a 12-month period. It is generally for that 3-month period. So the month in which the hardship occurs and then the month on either side. Also, to apply for a hardship exemption, you can submit an application through the HSRI website, which we can look at in just a minute. And when you apply for an exemption based on a hardship or membership in a recognized religious sect whose members object to insurance, you can complete or submit the exemption application through UHIP. So what we're pointing out here on this slide is the fact that certain exemptions should be applied for through, excuse me, when I say UHIP, I mean the HSRI system in which you originally applied. So you could fill that out through UHIP, but then there are certain qualifying events where you could qualify by applying through your federal tax return. So if you're applying based on a membership in a federally recognized tribe or eligible for services through an Indian healthcare provider, incarceration, and membership in a healthcare sharing ministry, you can claim that exemption when you file your 2015 federal tax return, or you can complete and submit the exemption form in UHIP. Probably in this case, it would be more streamlined for a customer to do it through their federal tax return because they have to be filling that out anyway. And then how do you do it? If you're going to be going through what we call UHIP, which is the HSRI site with your application in it, your account in it, you would log into your account and click on the Task tab. So when you log into your account, you'll be on your account home screen. And then you want to just look across the top here. There are a number of tabs, and you'd want to hit on the Task tab. Once you're in the Task tab, you can see down at the bottom you have 3 options. You can file a complaint, you can apply for an exemption, or you can file an appeal. So obviously you'd want to hit on the Apply for an Exemption, and then you'd fill out the application that comes up. So I think we're going to actually stop for a second there to take some questions, if we have some.
We do have some questions, so we're just handing them to Carson right now rather than me read them out. So hold on just a second.
So I think the question was whether you pay the penalty for every month if you had coverage for some of the year. The answer is you will only pay the penalty for the months in which you did not have insurance. So I know I think my example was a little convoluted when I said it. So if I was somebody who did not sign up during open enrollment, so I didn't have coverage, say, for the months of January, February, March, April, May, all of a sudden I realized, oh, I have a qualifying event in June. Then I come in and I get insurance for June through the rest of the year. So I have what we consider to be MEC, which says, yes, you had the coverage that is mandated to be had for 6 months of the year. You would only be required to pay the penalty for the first 6 months of the year. And it's not a flat number because it's dependent on each person's individual income, but it was the greater of either the 2% of your income or I think it was $395 per adult, 160 something per child. So whatever is the greater of those 2 numbers, then you would only pay 6 months worth of that as a prorated amount. Okay. So we had the next question was, is somebody who is under 18, what is the age? Yeah, okay. What is the age threshold of an adult? So I think I said under 18. So at 18, yes, exactly. At 18 years old, they are an adult. So 18 and over would be considered an adult. 17 and under would be considered a minor. On the day of the
I think the question was whether it starts on the day of the person's birthday. So are they only covered through the last day that they're 17 and then the first day
Nope.
they're 18?
No. So we cover for a month of coverage. So it would be the last day of the month in which you turn 18. So if I turned 18, I'd love to believe that, but if I turned 18 on, say, September 15th, my coverage would cover me through the end of September, and then I'd need to have new coverage as of the first of the month. Excuse me, I would be considered an adult. Yeah, so the penalty, yeah, sorry, for the purposes of the penalty, I would be considered an adult starting in October. Okay, and it looks like there might be one more question here. Okay, I think we're going to hold that question. So do we have any others?
We do. Somebody who is a navigator responded and said, we were told that to be considered unaffordable under ACA insurance premium, we need to be greater than 9.5% of income. Is that not true?
So that's a really good question and a really tricky answer. So that actually refers to whether or not your employer-sponsored insurance is considered affordable, which is a little bit different than what we were talking about. So if you're offered insurance through your employer, then if that coverage meets, it's actually 9.56 for 2015. So if the coverage is considered to be less than that for the individual who's being covered, then it is considered affordable. Keep in mind with that one that it unfortunately is only in reference to the actual employee. So if, say, the employee coverage is considered affordable, so it costs less than 9.56% of the employee's salary, then, but the family coverage might be much over that threshold, it's still considered affordable. I hope that answers that question. I'm not sure if we have any others.
We have one more question, so just bear with us for 1 second.
Okay. So the question is, how do you find the cost of the bronze plan for the HSRI on or another source? So you would need to go onto the HSRI. They would need to call the call center. We have a rate sheet that we use that has people's. It's dependent on your age. So it's hard for us to put up a chart that shows exactly what that lowest cost is because it's dependent on your age. But we can certainly answer that question if somebody calls the contact center.
And I think we had one other question that we're going to research and get back to later. So why don't we go ahead?
Okay, great. So next we're going to talk about the premium tax credits. So this is probably, for some of you, this is going to be a refresher from our webinar last year. And for those of you who were not here last year, then this will be new for you. So the premium tax credit is the refundable tax credit, and it's intended to help individuals and families pay for their health coverage if they can't afford a full-price plan. It is only available if you have coverage through HSRI. So in other words, if you went directly to one of our carriers off the HSRI market, then you would not be eligible for any tax credits. There are two options with how you go about obtaining the tax credit. One is that what we call the APTC, which is Advanced Premium Tax Credit, which basically means it's paid directly to the carrier on a monthly basis throughout the year. So essentially you're getting it in advance. Or the Get It Later, which means you won't get the tax credits ahead of time, but when you file your tax return, you can recoup the cost of those tax credits. It's really up to an enrollee. They can do one of those two things. They also have the option to take a portion of it each month and then wait for the rest to file their taxes. That's kind of a good approach for somebody who isn't really sure what their income is going to be at the end of the year, if they have kind of a vague idea, but it could go up, it could go down. If you take only maybe half to 3/4 of the APT, of the tax credit that you are eligible for, then when you file your taxes, you may see less of a tax liability at the end of the year if you didn't get your income right. So APTC versus PTC. You've probably heard the term APTC, but the PTC is what the IRS uses. So as I mentioned before, APTC is the Advanced Premium Tax Credit, which means it's taken in advance during the policy year. There's no way for somebody to know until the year has ended how much income you actually made in a year. So you project, when you apply for insurance, you project what you're going to be making for the year, and you receive a tax credit based on that projection. If you're close, then you should be in good shape. If you're very far off, you're either going to have to repay that amount that you were off by, or perhaps if you estimated too low, then you might be due some kind of refund when you file your taxes. So as I mentioned, the PTC is just a premium tax credit. So this is the actual amount that you are eligible for during a policy year. And it is based on that final income and your household size. As I mentioned, it's an acronym. The APTC is an acronym that a lot of people probably who are familiar with HSRI are familiar with, but the IRS does use that PTC. It's really the same thing, except that one is the projected and the other one is the actual. So to be eligible, an individual has to be an applicable taxpayer with income between 100 and 400 FPL for their family size. That's the federal poverty limit. They cannot be claimed as a dependent on somebody else's tax return. And if they're married, they must file jointly. We had an instance where people were trying to file separately, thinking they would get more tax returns, and then at the end of the year identify that they were married and filing separately, and then they had to pay back all of the tax credits or make the decision to file jointly. They must also have at least 1 month of coverage in a year. Obviously, if you're not covered at all during a year, you're not eligible to receive the tax credit. So you need to be enrolled in a QHP through the exchange or marketplace. Not eligible for minimum essential coverage elsewhere. So we mentioned before about the employer-sponsored insurance. If that's considered affordable, then it's a disqualifier for tax credits. And of course, you have to pay your premiums in order to be eligible for the tax credit amount. So key considerations when you think about the tax credit are that it is optional to take them in advance. So it is absolutely not a requirement. It really is up to the comfort level of the person who's eligible for the tax credit and what their needs are. You are required to reconcile those tax credits regardless of any other filing requirements for you. And the differences between the advance credit payments and the final credit are highly likely. In other words, the chances that somebody gets their income right to the dime at the end of the year is pretty unlikely. So it's very likely that we're going to see either somebody who overestimated their income or underestimated their income, and then we'll have to reconcile. Either they'll owe something back because they took a little bit too much in the tax credits, or maybe they'll receive a little bit higher tax credit back at the end of the year. Additionally, changes in any circumstances can affect the PTC amount, so we always encourage people to report any changes throughout the year to us to avoid having anything too discrepant. So for example, if you get a big raise midway through the year and never report it to HSRI, you're going to continue to receive a tax credit that you really probably are no longer eligible for. And when you file your taxes at the end of the year, you will need to be responsible for paying back any overage. And again, you must file a tax return, even if they are not otherwise, even if the taxpayer is otherwise exempt from filing. So if their income filing is too low, if they received, or below the filing limit, then if they received a tax credit, then they are responsible for filing those taxes. And here's just a quick look at the current FPL levels that were used for 2015 for QHP. It's a little bit confusing. So the 2014 FPL is used for the 2015 year. So here you can see for an individual, the low end of the FPL is 11,670, with the high end being 46,680. So if you fall in between those two, you're likely eligible for a tax credit. and if you're otherwise eligible as well. For a family of 2, it's $15,730 for the 100% FPL, or $62,920 for up to 400%. And then for a family of 4, for 100% FPL, they would be making about $23,850 for the household, or up to $95,400 for the household, and could still qualify for tax credits. And just a little note there, in Rhode Island, an adult with income below 138% FPL is eligible for Medicaid, because Rhode Island did do the Medicaid expansion. And as I mentioned before, those changes in circumstances, we do see a lot where people do come in and make an update to their account at some point during the year, which is great. We really encourage people to do that so we can get as close as possible to the right number by the end of the year. Eligibility for a PTC, even if not previously eligible. So in other words, if you're somebody who came in, applied, was maybe above that 400% FPL, and then maybe you got laid off, then we would strongly encourage you to come in and report your updated income, and let us know, because you may now be eligible for our tax credit. And that can go in either direction. So if you at the beginning of the year are unemployed, you may have a tax credit, and if you get a job midway through the year, you would definitely need to come in and report that to us. Examples of major changes are marriage or divorce, increases or decreases in the number of dependents in your household, a change in an individual's residence, a job or other changes increasing or decreasing your income, the loss of other health coverage, or changes in filing status. And I think we were going to stop here again for some questions.
Yes, we do have several questions, so give us a second for Carson to read them.
So the question was whether or not the applying for exemption because of the insurance being unaffordable, is that based on MAGI, which is what stands for Modified Adjusted Gross Income? And the answer is no. It is actually based on adjusted gross, the AGI, which is the adjusted gross income, which is different than the Modified Adjusted Gross Income.
Okay, and then we have a couple other questions.
Let's see, it says, yeah, dependents do not get tax credits even if they are in the taxes. So the tax credits are determined actually at the household level. So even though it looks like it's one person receiving the tax credits, it takes into account that the children are on the account, and that tax credit is for the entire family, not just for the adults in the house. I'm just reading the rest of the question to make sure I've got everything. Mom and dad and daughter. Right, okay, so if you have a household with a mother, father, and a daughter, they are getting tax credits for all 3 members of the household. It's just one tax credit amount because you get them at the household level. Yeah, and then the other kind of side note here is that a person who's a dependent cannot enroll and get a tax credit on his or her own, so they couldn't create their own account if they're dependent. They could create their own account, but they wouldn't be eligible for a tax credit if they're being claimed on a different on their mom and dad's tax return. I'm looking to see if we have any other questions.
We have one more about 100% of federal poverty level.
Okay. Okay. So we had a question. It's a good one. A question about let's see. I can go back to this. Oh, I don't know if I can go backwards on this. The question was about if you were below 100% FPL, not being eligible for tax credits. That's right. And so the reason that some people there is one caveat to that, and that caveat is if you are a legal permanent resident, but you've been here for less than 5 years and your income is below 100% FPL, you do qualify for tax credits. But that is an exception.
And I think we're just adding an extra qualifier to that, so hang on one quick second.
Sorry. Yeah, I'm going to put Linda on because she's going to give one qualifier. Hold on.
Hi, this is Linda Katz. I just wanted to add a little bit to what Carson just said. As people know, if you're people with income below 138% of the poverty level are eligible for Medicaid. Some people who are lawfully here as immigrants are not eligible for Medicaid. And so the rule is that if you're ineligible for Medicaid solely because of immigration reasons, then you can get a tax credit even if your income is below 100% of poverty. So people who are not eligible for Medicaid because of immigration bar, like the 5-year bar for lawful permanent residents, can get a tax credit, and they can qualify for tax credits even if their income is below 100% of poverty.
Great, thank you, Linda. Hopefully that helped to clarify a little bit more. All right, any other questions before I plow through? Okay, here we go. All right, so let's dive into the 1095-A form and just talk about the basics of this form. As I mentioned before, it is issued by HSRI to all QHP enrollees, regardless of whether they received an APTC during the year or not. If you are somebody who is enrolled through HSRI and in a QHP but did not receive APTCs and are not eligible to receive APTCs, you will also be able to check that box saying that you had coverage for the entire year. If you are eligible for APTCs and want to get that tax credit, you will need to fill out Form 8962 to get that money get those credits when you file your taxes. As I mentioned before, it will be sent by January 31st, and it's going to show documentation of coverage by month and family member, the premiums of coverage selected, so whatever plan you were enrolled in, the premiums of the benchmark plan, and the benchmark plan is what is used to calculate anybody's APTC eligibility. And then there will be a line that will show the advance payments of any PTC. Generally, you're going to get one form per household per health plan. So if you had more than one health plan selected during the year, then you'll get more than one 1095. If you switch plans for some reason during the year, if you had a qualifying event for an SEP and decided to go with a different plan, then you would receive 2 different 1095s. If you are a household that happens to have 2 different tax households within it, it's rather unusual, but it does happen sometimes, you will receive 2 1095As. There is no form this year required for people who were enrolled in a catastrophic plan for 2015. Additionally, this is important to note, once it's distributed, a copy of that 1095A will be in the enrollee's online account in their Notices tab, so it can be downloaded at any time if they've misplaced it or haven't received it. As soon as it gets generated to be mailed out to a customer, it does go into their account, so they could potentially, if they're watching it like a hawk, they could get that a little bit earlier than when it would reach their house. Okay, moving along, or trying to move along. There we go. Also, the IRS does get a copy, the idea being that both you and the IRS will have the same information, and so it will be a really quick, easy process to verify that when you file your taxes that the amount that you're claiming that you had coverage for and received any tax credits for, the IRS will have the same information. It isn't available early, although at this point we're already sending them out, so it shouldn't be a problem. We did mail that Watch the Mail letter just to let people know that this was going to be coming, and it explained what the form is and the importance of waiting for it. So for the people who are getting a 1095A, they are the ones who should wait for that form to arrive as opposed to the B and the C. Also, some did you knows. For people with low and moderate income, those tax filers will typically file very early in the tax season so that they can obtain their refunds. And typically those checks that they receive are between $2,000 and $3,000, which are often the largest check they'll receive in a year. So that's the impetus for them wanting to file early. And that February is the peak filing season, with February 15th being a very heavy filing day. This is that Watch the Mail letter that customers should have received. By now, I would think pretty much everybody will have received it. And again, it just says, like, why is this form important? What am I going to do with it? And then there is a note about the 1095B in there because of those mixed households where people may be receiving both. We wanted to make sure to flag that for people, and when they receive that 1095B, not have them think that they are all set and can continue on. So what do you do with Form 1095A? Well, here's just a quick overview of the steps that you'll need to take. You obviously need to collect all of your tax information, including that form, and you'll use 1095A to fill in and information from the 1040 to fill in Form 8962. The tax filer cannot simply just attach the 1095A for their filing. They have to use the information to reconcile the advance premium tax credit. And Form 8962 does use the final income and actual size of the tax household to determine the actual final tax credit earned, and then it compares it to the advance premium tax credit paid. And as I mentioned before, the likelihood that those two numbers are exactly the same is pretty low. So it's great if you could help set that expectation up for customers, not to be alarmed if those numbers are off, because it's really difficult to project exactly what you're going to make in a year. So there are 4 possible outcomes to the federal tax return, and we're going to look at that in a few minutes. But first, let's look at each of these steps in detail. Oops. Okay, so for step 1, you want to check to make sure that the 1095A looks right. Just as we suggested with the 1095B, you want to look and make sure that the covered months are correct. If your 1095A shows that you had coverage from March through December, but you know that you had coverage from January through December, that's when you'd want to make a call to HSRI and get that corrected. Additionally, are the covered individuals correct? You want to make sure that all of your household members who had coverage during the year are reflected there. And then does the monthly premium look right? This one's got a little bit of a caveat to it because it won't be an exact match. A lot of you probably know that if the enrollee compares their information on the 1095A to their monthly bills, there's going to be a small difference in what they see for the premiums, because for tax credit purposes, the tax credits can only be applied to what's called the essential health benefits portion of the rates, which is just a little bit less than what the full premium cost is. So if a monthly difference is more than $3 different from what somebody sees on their bill as their premium and what somebody sees on their 1095A as their premium, that's when they should contact HSRI. But if it's anything less than $3, that is to be expected and should not be a cause for concern for people. If Form 1095A data has incorrect information for covered months or family members, they should, as I mentioned before, call HSRI. If they think their monthly premium is wrong, other than that small difference, they should also call HSRI to get those things researched and corrected. However, if the form looks good, the enrollee can proceed to step 2 and utilize that 1095A form to complete the 8962. So let's just briefly look at the 1095A. This is the top portion of the 1095A. The one difference from last year, you can see it highlighted there in red, is that there's now a void box. We had a few instances last year where people who had originally come in through HSRI and thought they wanted to gain coverage through us or see what they were eligible for, but never actually had coverage, did receive a 1095A, which should not happen. In that case, if that were to happen again this year, when they contact us to say, I really shouldn't have received this, we would be able to go ahead and put a check into that void box, and everything would be empty in the rest of the 1095A, and that form would be sent out to the customer. That is not something that the customer would need to wait to file their taxes for, but it will be something that they would want to keep in their record, potentially, with their tax returns. So you can see in Part 1 of this form is just the recipient information. Part 2 are those covered individuals. So again, you want to be looking to make sure that those individuals who are covered are the correct people, and that everybody who had coverage is listed there. Whoops, I got a trigger finger here. And then Part 3 is the information about the tax credits received. So you've got the months, that monthly premium amount, and again, that's the amount that's going to be slightly different than what somebody might look at see on their bill as the full premium amount. Column B is the monthly amount of that benchmark plan, or what's called what's known as the second lowest cost silver plan, which is what the APTC calculation is based off of. And then column C will show what actual premium tax credits were received for each month. And as I mentioned before, the question came in about who gets the tax credits in the household. Again, this is a household number. This is not broken out by person within the household. So the correction process for Form 1095A is, again, they should contact HSRI at the number listed here. We have trained all of the staff to answer some basic level questions about the 1095A, but if there are questions that would require research, we do have a specialized group of people who will be working on those. It would be really helpful if you have somebody who needs to have a form corrected, and to just set the expectation with them that it's unlikely that the issue could be resolved in one phone call. There's probably going to be some research that needed to be done. So if you could help us set that expectation that they'll give us a call, we'll collect any information that we might need from that customer, and then plan to call them back when we have a resolution. If the form is incorrect, then we will send out an amended 1095A, and again, it will be sent out to the customer and put up into their notices tab in their account. And just a note that would be really helpful for you to share with customers is that for privacy purposes, we can't talk to tax preparers. If somebody wants to put us on speakerphone and they can ask the questions while they're with their tax preparers, they can certainly ask the questions, but we can't talk to a tax preparer directly. So step 2, if the enrollee, or more likely the enrollee's tax preparer, utilizes 1095A information and data from the 1040 to complete the 8962. So they'll be needing to do that. If an enrollee received an APTC or wants to claim a credit, they cannot use 1040 Easy. That's a really important point, because I know a lot of the population may be used to using the 1040 Easy, but for the tax credit purposes, you have to use the full 1040 form. So I think, were we going to stop there for some questions?
Yes, and we have just one question, which is asking if you can get both the 1095A and the 1095B if you were enrolled in QHP and Medicaid in 2015.
Okay, so the answer to that is yes. So for example, if John was enrolled into QHP from January to April and lost a job and then went on to Medicaid in May, that he'd get a 1095A for January through April, and then a 1095B for May through December. So you can definitely receive both of those forms. And he would still check that box for to say that he was covered for all 12 months of the year, but would obviously need to reconcile with the 8962 for any months in which he received tax credits. I think that's it. Any other questions? No? Okay. I've either put you to sleep or I'm so thorough that there are no questions. I can't believe it. I hope it's the latter. Okay, so here's a snapshot of Form 8962. It doesn't show all of the sections of it because it would be so small that even I couldn't see it. But this just shows you what the 8962 looks like, and that this is what would need to be sent in with a tax return for anybody who received tax credits or who would like to be applying for tax credits for 2015. That form has 5 parts to it, which are the annual and monthly contribution amount, the PTC claim and reconciliation, which would show you the difference between what was claimed and how much should have been claimed. And then part 3 shows the repayment of any excess of advance payment, whether you need to repay or you should receive some in your tax return, or it would offset anything you might owe. Part 4 is a shared allocation, and then Part 5 is the alternative calculation for marriage. So for somebody who maybe got married mid-year and they had to combine households, there is a section there that can take care of the complications that could come with that. So as I mentioned a few slides back, there are 4 possible outcomes when you file that 8962. The first one probably being the least likely, where the APTC received in advance, so that the tax credits received actually equal the amount that they should have received. So there's a zero change. And again, it's unlikely that we would see too many of those, but certainly possible, I'm sure. The next one is where the APTC is greater than the PTC. So the amount that you thought you were going to make during the year, you applied with and received a tax credit per month, but you ended up taking more tax credit than you really were due. So the taxpayer would need to pay back the excess tax credit, subject to the repayment limits, which we're going to talk about in a minute. The excess amount reduces a refund, or it's added to an amount due. So if you owe money already, then this would be an additional money that you would owe, or you'd have to pay this back if it's the only thing. The next one, which is the one we would hope for a little bit more, is the APTC is less than the PTC. So the projected amount of tax credits or of income that you said you were going to be earning might have been more than you ended up earning at the end of the year. So you only took a certain amount of tax credits. Or it could be that you decided to take only maybe half of the tax credit you were due, or a portion of the tax credit you were due. So you'll find that you're able to reconcile and were eligible for more tax credit. In this case, the taxpayer would receive any amount of credit either through a larger refund or to offset any amount they might otherwise owe to the IRS. And then the last one is the APT is not requested, but the taxpayer is owed a PTC. So, for example, somebody might not want to have to go through the longer application when they file for tax credit for their insurance through HSRI. They can indicate that they are not applying for assistance, and then at the end of the year, when they file their taxes, they can also file a Form 8962 to show that they should have they were eligible for and should have received a tax credit. This is their opportunity to get that. And just like with the previous outcome, the taxpayer would receive any credit due either through a larger refund or to offset any amount that they would otherwise owe. So here is an example of where somebody, that instance where somebody projected that they were going to make more money than they actually did and therefore took more tax credit than they should have. So for this example, we're saying that the advance payments were $4,000, but when they filled out Form 8962, they realized, oh, I was only eligible for $3,000. The difference here is $1,000. So the repayment amount that the customer is responsible for is $1,000. And this would be entered onto Form your 1040, your tax return. And again, just another reminder, a tax return must be filed to reconcile any APTCs regardless of whether the other filing requirements are met. So is there a limit to the amount that someone can owe the IRS? And the answer is that in most cases there is a limit. Individuals and families with income below 400 FPL are protected by repayment caps. However, if the income is at or above 400 FPL, there are no repayment caps. So if you grossly underestimated your amount of income when you applied for insurance through HSRI and got a large tax credit, and then at the end of the year you ended up making much more money than you anticipated, you would have to pay, and we're over 400% of FPL, you would have to repay the entire APTC amount that was given out for you. So here is a chart with the repayment caps, which would probably be a really important one for people to print out and have handy when they are talking to people. So if you are less than 200% of the FPL, then the individual cap is $300. So even if you got, say, $1,000 worth of tax credit, and you were an individual that fell into this category, you would only have to pay $300 back. And for the family in that situation, it's a cap of $600. If you are at least 200% but less than 300%, the cap is $750 for an individual and $1,500 for a family. If you're at least 300 but less than 400, the individual cap is $1,250. The family cap is $2,500. And as I mentioned before, for anybody over 400% or over, there is no cap. So they would be required to pay back all of the tax credits that they took that they should not have taken. So here's an example. Let's say that this taxpayer is an individual, and they are at 350% of FPL. If they took a total advanced tax credit of $2,952, but their total tax credit that they were eligible for when they reconciled at the end of the year is actually $1,062. The difference there, that the overage that they would owe, is $1,890. However, because they are at 350% FPL, the CAT for that segment of people for an individual is $1,250. So although this individual owes $1,890, took $1,890, they would only have to pay back the $1,250. That is deducted from any refund they might be receiving or added to any tax liability that they would have to pay. I think we were going to stop one last time here for some more questions.
Okay, so we have a very long question, so you may have to bear with us. So the first half is on the ACA worksheet where individual shared responsibility payment is calculated. They ask for a dependent AGI when the dependent is required to file a tax return. We assume that if the dependent does not have a filing requirement, then we do not need to include the dependent income on the ACA worksheet to calculate the shared responsibility payment.
Yeah, I think that question is a really good question, but I am not a tax professional, and it definitely is a question that would need to be referred to a tax professional. I think it's a little bit outside the scope of what we're able to answer for questions today.
And I think the rest of that question also has the same answer. So we would refer you to your tax preparer. And that is all we have.
Okay.
Are there any other questions?
It's not your last opportunity. All right, so I'll move on. We've got just a few more slides left, and then we'll bring it back for any final questions. So again, write anything down if you don't know the answers. Okay, so for help with filing taxes, two things here. Sorry about the red. I know it's not the prettiest color, but there are important points that we wanted to make sure you understand, and that's actually very much in line with the answer that I just gave with that last question, which is that the people who are answering the phones at HSRI and the specialized team to help fix any issues with the 1095, they cannot provide tax preparation assistance, and they cannot provide any tax advice. It's really, as much as we would love to be completely full service, it's just not an area of expertise, and so it's really something that we would suggest to refer to some resources that we're going to be suggesting in just a minute. We do encourage enrollees to work with a qualified, experienced tax preparer, and a lot of enrollees actually have an existing relationship with a tax preparer, but if they don't, then we would recommend that they ask trusted family and friends for any referrals. And again, there is tax prep software, so if somebody's comfortable with using a program on the internet, then they could definitely walk themselves through any one of those tax prep softwares and be able to correctly use their 1095A to get through those forms. They are obviously encouraged to select a tax preparer carefully. Any qualified tax preparer should be familiar with health insurance tax credits and shared responsibility payment and exemptions. Definitely recommend that when somebody's looking for a tax preparer, they ask those questions. And if the tax preparer is not able to answer questions about the health insurance tax credits or the shared responsibility payment or exemptions, then that is not the tax preparer for them. There are some free tax return prep there is some assistance. I know we have some people, I think, on the phone who are members of the VITA program, which is awesome. They do offer free tax help to people who generally make $53,000 or less, people with disabilities, the elderly, and people with limited English-speaking capabilities who need assistance in preparing their tax returns. They are IRS-certified volunteers who provide free basic income tax preparation with electronic filing to qualified individuals. Additionally, there's something called Tax Counseling for the Elderly, the TCE program, another great program, which offers free tax help for all taxpayers, particularly those who are 60 years of age and older. And both VITA and TCE help is not, I don't think it was available until later in January. I'm thinking that by now, I'm not sure we have the exact date right, but by now I think they're all up and running. So for a list of any of these sites, you can go to this website.
And they're also on our Health Coverage Project website. We'll be posting those and emailing them out as well. Great.
Additionally, for paid sources of tax preparation, there are CPAs who can do your taxes. There's certainly those tax prep firms such as H&R Block and Jackson Hewitt and Liberty Tax and certainly many others. There are plenty of independent tax preparers, and as I mentioned before, there is that tax prep software. So if people are really comfortable using the internet and filling out information online, that is a very good, they really do walk you through each step. So it is a good option for people as well. Additionally, our friends at RIREACH are offering Help for Consumers, which is such a fabulous program. And they have specialists who can help with all the 1095 forms, A, B, and C, as well as Form 8962, and then that Form 8965 that I mentioned before. And they can also help with exemptions for the individual mandate. They will support both consumers and advocates, enrollers, and any helpers. And can answer general questions, pursue corrections to form, and help apply for exemptions. However, as with the call center reps at HSRI, RIREACH is not going to provide tax advice. So they will help you get to the right people, but that is not their job to give actual tax advice. And here's just a list of resources. And again, you all should be receiving a copy of this if you haven't already. So you can use this to be able to gain some information about what people will need to know when they file their taxes. And I think that's it. I don't know if we had any final questions.
We don't have any in the queue. We can give folks a couple minutes to ask any, but we here at the Health Coverage Project do plan to send out both a copy of this webinar, the recording, and the slides. We also are going to send out sort of a tax packet that includes some other documents like fact sheets and the list of VITA sites and some other resources for folks. So stay tuned for that. Someone did ask how they could get a copy of the slides. They are available already on our Health Coverage Project website, which is listed here. And then we will send them out as well if you didn't get them already. Sure. So just on the resources slide real quick, we're going to go back to that real quick. Maybe.
So I think I have to do that. Hold on.
Thank you.
Yep.
So on the fourth one down, this is us at the Health Coverage Project. And then underneath, this is Sam Salgonic, who is with RIREACH. It's a separate project of RIREACH, and he has some great resources on his website as well to help folks navigate all of these questions. And I don't see any other questions. So with that, thank you very much, Carson, and our question and answer team in the background, both John and Kathy and Linda. And we hope you got a lot out of this workshop today, and we appreciate everyone's help. Thank you very much. Goodbye.